Hi, everybody. Welcome to Market Insight for Monday, January 27th. I'm Jeff Yastine, and I'm joined, of course, by my colleague and friend Ian King, editor of Automatic Profit. So, Ian, welcome.
Jeff, how are you doing?
I'm doing good. Coming off a nice weekend, and everything's going well. Let's talk about the coronavirus, since that's getting a lot of the headlines. Obviously, this is an evolving story, as these sorts of things tend to be. What's your view as far as impact, if any, that people should be thinking of here on the market in the coming week or two?
Mm-hmm. Well, it sounds like it's a pretty big scare in China right now. You know, they put that city, Wuhan, on lockdown. No trains going in and out, no planes going out. They're checking cars to see if people who are traveling to and from the city have signs of the virus. And just to give our viewers a bit of a background, if you don't know, it started at a food market in the center of this city called Wuhan, which I didn't even know this. The city has 11 million people. It's huge. It's not a small city. It's bigger than New York. And we don't know what type of animals. They say it's come from snakes or bats, and it went originally from animals to humans, but then the virus mutated and it started going from human to human. So far, I think there have been about 15 people that have been killed from the virus, mostly elderly with weaker immune systems. And China reports there's hundreds of people that have been infected. Now, here's the thing that I worry about, because China has already said there's a couple other cities in the province that are also being on lockdown. The Chinese government is not always honest with numbers they report to the public. And we know from history, they've overreported economic growth for decades, and you can't really trust their numbers. So when China says there's hundreds of people infected, I worry that the number could be thousands. Now, having said that, the good news is with the kind of command economy they have the resources, probably more than anybody else, to really just shut down the spread of the virus. You know, they shut down all transportation in and out of the city. And that gives me a little more optimism that we won't see a mass spread of this virus, but it's really too early to tell. I just want to mention one other thing, because I was looking at the CDC website, and this is the best website really to monitor this infectious disease, but CDC says it's not clear yet how easily the 2019 and coronavirus spreads from person to person. It's important to know this is in order to better assess the risk posed by the virus. So it could either be something like the flu, that somebody around you has to sneeze, or something as contagious as measles, where if an infected person goes to an area and then it stays in that area on objects and things, and you don't have to get it person to person, you can actually get it just from the vicinity of where they are. That to me is a little scary. What do you think about that?
Well, really, when I view these things, and especially when it comes to think about in terms of as an investor, my thought is, all right, how many people are affected? Right now, there's half a dozen, something like that. To me, when you think about a nation the size of China with 1.2, 1.3 billion people, I not that I don't worry about it, but as an investor, unless or until we see more evidence of what you were saying, that there's more going on underneath the surface, I'm not going to worry about it as an investor. It's a tragedy. It's a human tragedy anytime somebody dies from one of these things. But beyond that, I'm going to keep a step back here and just think about market impact wise. As long as our market is going up, then I have to just believe that this virus outbreak, in whatever form it is not going to affect ours. If our market was going down, I'm sure somebody would say, it's because of this viral outbreak in China and fears of that sort of thing. Until that happens, I'm not really going to worry about it too much as an investor. I do think, though, that authorities, globally, obviously they're very aware of it. And I think as long as they're aware of it, they are putting together the appropriate protocols to make sure it doesn't spread and has a limited impact. A lot of this reminds me of the SARS virus scare in the was it the mid 90s, I think it was.
2004.
I think it was the avian flu in China.
Yeah.
And spread to different parts of Asia. it did induce a bit of a sell-off, as I recall. But ultimately, it wasn't really that big of a deal. It was a lot of headlines, but it didn't really have that much economic impact, and the number of deaths were quite small given the overall population of that region, much less Canada and the U.S.
I see your point, and you really have a lot of faith in government, Jeff, I have to say. But
well, let me put it this way: it's faith in health authorities, because they're the ones that go through these protocols. And as a former journalist, I've seen this sort of thing happen in local communities. And generally, if the people in charge are well trained, and they are at the CDC and all that, Center for Disease Control, generally they're able to limit these sorts of things. Again, we've seen these sorts of outbreaks periodically from different parts of the world. Ebola, now this, I mentioned SARS, and generally, they have a limited impact. There could always be that one pandemic that outstrips it all, of course. But until or unless we start seeing evidence of that happening, I'm not going to think about it too much as an investor.
It's funny you bring up Ebola, because that's the more recent case of a infectious disease that spread. And I went back and looked at the data. Now, it happened in the fall of 2014 is when this disease started mutating and becoming a big thing in Africa. And, the markets were in a different position in 2014 than they are now. I think it was the end of QE. They were talking about the taper tantrum. So the markets were in a weak position. But I have to say, between mid-September and mid-October of 2014, the market pulled back 10%. And, obviously, if you look at a 10-year chart of the S&P over the last 10 years, that was a little blip. It was a great buying opportunity. But the things that got hit the hardest, and I was on Fox Business News the other morning talking about this, the airline stocks, the cruise ship stocks, any of these places where people aren't going to travel anymore are going to get hit the most if we start seeing more of a spread. So, if you're an active trader and you're following the story, put some of those airlines on your screen and just keep an eye out for them, because the hedge funds that probably have much more insight and more data on what's happening with the coronavirus, those are the stocks that the big funds are going to short first and look to profit on a decline on before anything else. JetBlue, for instance, during that 2014 period, pulled back 20%. Delta Airlines, which does more international travel, pulled back 30%. Airlines obviously are volatile, but you have to, admit that it was linked to that spread of Ebola, that drop that we saw in 2014. So
sure, and it's just a matter, I think, of whether all of us as participants in the market, are you a trader, speculator who's kind of in and out and doing those sorts of things, or are you investing for longer periods of time, whether it's 6 months, a year, or 2 years? Obviously, if your perspective is somewhat longer, if the hedge funds are happy to short an airline stock or cruise line and give me Royal Caribbean at a 15% discount, so I can pick up a nicer yield on the dividend, I'm more than happy to take that trade. I'll tell you what, let's move on to Tesla, because Tesla has earnings coming out this week. What is your view about the stock and what people perhaps should be looking for once those earnings come out?
Yeah, Tesla seems to be the stock du jour, the thing everything's talking about. You hear not only people in the financial community talking about Tesla, but people in the real world. I know it's kind of one of these battleground stocks where you have just as many shorts as you have longs, and their voices are heard by everyone. But I want to just pull up this chart for readers, because we all know Tesla's been on a crazy run. We own it in the Automatic Fortunes portfolio. We've owned it since August, and we've more than doubled our investment in it. But
congratulations, by the way. That is a great trade. And to buy it when you did, which was what, 6 or 7, 8 months ago, I remember looking at that, and that was a great recommendation. And my hat is off to you, because at that time, there were a lot more very vocal bears out there, and you don't hear them now with the stock having done what it has.
Yeah, well, thank you for that. I think one of the main catalysts in my mind was Tesla had kind of an existential crisis in early 2019. Elon Musk was under investigation by the SEC for tweeting out that he was taking the company private at 420. He was being fined and heavily scrutinized. On top of that, they had to raise more capital. The stock dropped below 200. They got the capital raise done. So it was kind of like a perfect storm. And investors, in hindsight, will always point to that part where everything seemed to go wrong. But when everything seems to go wrong, it's usually the bottom, right? Okay. So I thought that, this stock has an enormous opportunity in the future. We're going to see a 50 to 100 times growth in electric vehicles in the next 10 years. And if you've ever test driven a Tesla and test driven another company's electric cars, there's just no comparison. And, it's funny, what I tell a lot of our readers in Automatic Fortunes is that if you drive a Tesla and you look at their specs in terms of how much mileage you get per charge, acceleration, and then what the cost of the car is, and you compare it to electric offerings by Volkswagen, Ford Mustang has an electric car coming out. Even in the high end, you have Porsche. In the SUV class, you've got the Audi and the Jaguar with electric vehicles. If you compare Tesla's vehicles to them, there's no comparison. And I liken it to this idea that Microsoft, back about 7 or 8 years ago, decided that they were going to have an iPhone killer, okay? And they did this joint venture with Nokia. They spent $5 billion on it, and they released a smartphone. This is Microsoft, because they wanted to compete with Apple. And people went out, because there was a lot of marketing behind Microsoft's smartphone. They went out and they looked at they went to Best Buy, and they looked at the Microsoft smartphone, and then they saw the Apple iPhone, and there was just no comparison. They came home with an iPhone. The same is going to be true with all these automakers going electric. People are going to test drive a Volkswagen electric or a Honda electric, a Chevy electric, and then they're going to say, well, I might as well, if I look online, all the ratings are much better for the Tesla Model 3. I might as well give it a test drive, and it's just selling itself. So, I think that's a huge catalyst for Tesla, that other automakers are going to electric. And they've all admitted that they're 7 years behind Tesla's technology as it is. Mm-hmm. And I think that they've got too much of a head start on everyone in the electric vehicle. One last thing, because I know this is going on, but what investors have to be cognizant about is that even though government subsidies are being taken off these electric vehicles, this crossover point where producing an electric vehicle becomes cheaper than producing an internal combustion engine is coming in the near future. And this is going to be huge for Tesla's margins, because battery technology has gone down. The cost of producing a lithium-ion battery for one of these cars has gone down significantly in the last 10 years. It's dropped by over 90%, and it continues to decline even now. And that is going to make an electric car cheaper than an internal combustion engine. Say goodbye to the gas guzzler in the next 5 years. If you're going to bet on the sector, you have to bet on Tesla. It's had a huge run right now, so you kind of want to be cautious after anything runs up 2x. But this move is something that I see continuing this year, just because of how much positive buzz, and now more shorts are coming in, and they're probably going to get steamrolled in the future too.
I'll give you my 2 cents on it. And I've gone on something of a journey here on Tesla stock. And I agree with everything you're saying about the vehicles. I don't own one, but I test drove a Model X a while back, and wonderful vehicle. I see everything that people are talking about. I wouldn't buy it at this level, simply because it hasn't gone on a huge run. And it's a matter of how much are you paying to own the earnings. But that is the impressive part about Tesla, is that they've had out of the last 4 or 5 quarters, they've had 2 quarters where they've reported profits. And if the analysts are correct about this year, about 2020, they will report, the estimates are that they'll report around $5.57 a share in annual profits for the coming year. If you look at the price of the stock, basically it's trading, and presuming they actually do earn those profits. The stock is trading at about 100 times earnings. That's expensive. But then again, if it's a stock where the earnings are growing at 100% a year, if they're doubling or even coming close to that, obviously you want to pay a premium to own that kind of growth. So if they can deliver on it this year and next, 557 this year, the estimates are for $12.70 for 2021. So again, that's more than doubling from what is expected for this year. If they can deliver on that, it's going to be a huge winner. So it's just a matter of at what level do you feel safe as an investor buying the stock? And if you're that convinced about it now, buying it at 100 times earnings, more power to you. If you're thinking Amazon, because you might very well be very happy that you did it now, but it's just a matter of everybody has their different levels of risk and what they'll pay and how convinced they are about the stock. And as you know, it's gone on a tremendous run, and I've had to change my view of the stock simply because they're producing profits. If they can keep doing it, it's going to be one of the stocks you want to keep an eye on, and then buy it on another pullback, or when we do get a market correction of some kind. Let's round things out here with a brief talk about Apple. And you have a chart, I believe you're going to show us for Apple, or we're going to talk about the price earnings ratio for Apple, which is very high. I think it's at the uppermost price earnings level, because I've looked at it myself for going back like 20, 25 years now.
Yeah, before I share this chart with viewers, I just want to do a little bit of background on Apple and what's happened in the last year. You know that Apple is one of those stocks. For a while, it was kind of flirting with the $1 trillion market cap, and then it broke through, and then it ran up another 40%. So just in 2019, put this in perspective, Apple has gained $600 billion in market cap. And that is bigger than every S&P 500 company except for 4 of them. So the run that this stock is on right now is absolutely historic. We've never seen anything like it. One of the reasons, or the catalyst for Apple's big move in 2019, is the expectations for the iPhone 11 sales were really ratcheted down by Wall Street. And the reason for that is we both know next year is going to be a huge year for smartphones. Qualcomm is out saying they're going to have 200 million 5G phones sold next year. So Wall Street said, you know what? Investors or consumers aren't going to go out and buy an iPhone this year. They're going to wait till the 5G phones come out. Boy, were they wrong, because I got to tell you, I have the new iPhone 11, and a lot of consumers like myself rave about the camera on this thing because it's got 3 cameras. And it is such a huge improvement over the 10 and the 10S, the last couple models, that people are willing to go and upgrade, and they can trade in their own. Apple does this iPhone trade-in program now. So for an iPhone 10, you get $400 back, a $400 credit, which is about 40% of the value of the phone if you bought it within the last 2 years. And it's led to a huge upgrade cycle, people moving the iPhone 11 that beat Wall Street's expectations. That was one of the reasons why the stock really took off. Go ahead, because I know you want to tell me something here.
Well, I am on record. I wrote something in December saying that Apple was one of the stocks you would want to short. I believe I said in there someplace to wait a month or two, because I knew that there would be a lot of buying coming into these shares at the start of the year. And in some ways, we're at the bookend of where we were last year. January of a year ago, Apple had very few friends in the stock market. And I remember going on Yahoo Finance telling people to buy the stock because it had fallen out of favor so quickly. It was just amazing. And now we're on the far end of that swing in sentiment. I wouldn't buy the stock here. I would be looking to short it because I do believe it's overvalued based on the price earnings ratio valuation levels that we've been talking about. It is at an historic extreme. My worry, speaking to it fundamentally, and all the great things you're talking about with telecom and 5G, is that this run up in the shares in many ways is sort of front loading, anticipating this big swell of demand that we're going to see, over the next 12 to 18 months for the rollout of 5G. I agree with all that. It's just a matter of, I do worry that the run up we're seeing now is basically front loading all those expectations. And unless it really blows everything out and people don't just stand in line, with lines around the block at the Apple store to get these things for 5G, that it'll be a disappointment to Wall Street in the quarters to come, and then we'll see some of the air let out of the stock. That's my big worry about it.
And that's a great point. But, Apple could sell like a piece of 2x4s if people would still line up outside the store but had the Apple logo on it. So,
well, what does that say though? What does that say about the stock? I mean, obviously, people are very enthusiastic. I would just worry about what happens if Wall Street, the institutional buyers who tend to move the prices on these things, if they become less enthusiastic at some point in the near future. But we'll see. I mean, that's what markets are made of. I'm going to let you have the last word, Ian.
Well, to your point, Apple right now, and there's a chart we want to share of the forward price earnings ratio. It's trading at about 24 times forward earnings. And what that means for viewers is basically you take the market cap and divide how much money they're going to earn per share in this year, and you get that ratio. Historically, this number has been about 14. It's because of Apple's rally, it's had it basically on just a multiple expansion. Earnings haven't grown. Sales are up like 6% year over year. So it's not seeing extremely high growth. It's just seeing multiple expansion, and that's why the price is going up. The one caution I have about Apple, especially at a 24 PE, is that they are the only large tech company that hasn't really invested in these kind of moonshots, right? If you think about Google, they've got Waymo, which is a self-driving car that could be worth $100 billion right now. Microsoft has a huge investment in the Azure cloud, and they're doing cloud services for businesses and consumers. And also, Amazon, of course, has got their hands in everything. They've got Blue Origin, they're launching rockets into space, they're doing all this stuff with delivery of their goods, and Amazon has Alexa and all kinds of artificial intelligent devices for your home. Apple really hasn't expanded past the iPhone, the laptop and the AirPods. And I think that investors are really kind of clamoring to see, okay, we heard Apple has these patents out there for perhaps a self-driving car. There was always been talk of the Apple TV doing a full screen TV. I don't know how much really that moves the needle, but I don't think Tim Cook is as forward thinking as Steve Jobs is. And, I look at this company as being like a utility stock for the next 10 years. You're probably not going to get much price appreciation past where it is now at 24 times forward earnings, but they've got a ton of cash. They could increase the dividend as well. And maybe they make some smart acquisitions in the near future that kind of gooses growth a little bit. But that's my big concern with Apple is they don't have this kind of moonshot program as other tech companies have. And so I would be a little cautious buying it up here at 24 times earnings.
All right. We'll leave it then with that. So Ian, thank you. Thank you for coming on to Market Insight. I'm always so glad when you come on, and I learn so much for each time that you and I sit here and chat about these things online. So thanks.
Same to you, Jeff. Talk to you soon. Thank you.
Thanks, Ian. And for all of us here at Market Insight, we'll talk to you next Monday.